Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today on the program, we have Miss Shedlock and Ira Harris. As a way of introduction, Mish is a registered investment advisor representative for Sitka Pacific Capital Management, and Ira is an independent trader, successful hedge fund manager in a prior life, and is also an analyst global macro consultant trading foreign currencies, bonds, commodities, and equities for 39 years. He was also CME director from 1997 to 2003. Welcome, gentlemen.
Pleasure to be on, Richard.
Great. So I thought we would talk about some major developments that have been happening in the last week or so with the in India. We see a lot of financial repression happening. It's been estimated that 82% of the entire physical cash currency is now out of circulation, and it's having devastating effects on the economy. The price of gold has been going through the roof, upwards to $3,000 US per ounce. And so I just was wondering your thoughts on that. Ira, if you'd like to kick it off.
Well, you know what, I blogged about it last night, and this has been a concern, but it was interesting because I got a lot of feedback on my discussion of this, and one particular respondent from India, and somebody else actually joined in and said, well, it's not as bad as some people think. So with that being said, the impact will be different than a lot of people think, that it's not as financially repressive, that they believe that it's an effort to raise more taxes. Well, I don't know. I know there's a lot of black market activity that takes place in India, and they're trying to recoup some of that tax. But I found it interesting that it came on top of the efforts by Larry Summers and others, especially Rogoff now, to go to a cashless society in an effort to be the ultimate, in my mind, the ultimate act of financial repression, because then they can take rates as low. You can go to negative 10% interest rates, negative 5%, and there's no penalty because everybody's just going to spend what they have rather than hoarding the cash like we've seen done. So my antenna are up, where I was certain that this was an act of financial repression. I will let people who were there and are more knowledgeable, and the fact that the guy who responded to me said that one of my favorite guys, Rajan, was actually in favor of this before he left. So I'm at a wait and see mode now.
And Mish?
Some of my readers said the same thing. I talked about this on my blog, and one of the things they said is a lot of the housing transactions are done with black market cash. So this might act to cool off is some of the wild inflation we've seen in Indian home prices. It's hard to comment on that from over here. We're not there. We don't see what the guy on the street sees. However, we can say for sure that central banks around the world are going to be watching this event to see what they can do and what they can get away with it. Cash is still king in places like Japan. Something like 80 to 90% of transactions in Japan are still done with cash. The Bank of Japan would like to outlaw cash. The EU has banned the 500 euro note, and Larry Summers here in the United States has proposed banning the $100 bill. Now, all of this is allegedly to stop the black market in currency. We're talking maybe 5% of the U.S. economy, 8%. Arguably, it's much, much higher than that in India, perhaps in Japan as well. I don't know. But that's not the real target. The real target is to get rid of cash. So they can track, the government can track every penny that you ever spend, make sure you pay taxes on everything you're supposed to, which, you know what? The reason why people hoard cash and the reason why people don't pay taxes is because taxes are too high. Banks aren't safe. Look at what's happening in Italian banks right now. The entire Italian banking system is on the verge of collapse. What better way for the Italians to get all that money back in banks so they can confiscate it than simply to ban cash? That is the real agony behind this. They can say that this is for fighting fraud. That's nonsense. It's so government can confiscate cash at will. That's really behind this. So no one in the long run is benefiting from this move.
And could this actually accelerate the trend in negative interest rates? In other words, make it more into negative territory? Ira, you mentioned in your commentary yesterday, in a cashless society, a central bank could impose negative interest rates of, say, 3% and not worry about cash being hoarded.
Well, yes, and Mitch is saying the same thing. That's what we're alluding to. And this concept of, well, we're going to drive out the illicit transactions. You know what? This is a big country. The EU is a big country. If I have to put up with 1% of the economy, 2% of the economy being involved in illicit transactions, black market economy, to safeguarding my liberties of controlling my own financial situation, I would put up with that. I'd put up with 5%, and whatever number you want to come up with. So they attach it right. It's what they hide behind. There's something greater here, and that's the fact that they can't stop people. They can't stop people. The models, which are static models, they're not dynamic models, they're static models. I had to listen to Mark Zandi today talk about how he did a static analysis of Trump's potential tax changes. Who cares about static? Static analysis, to me, static models are ridiculous because people are always in motion. And the motion is when people are reacting to negative or zero-based interest rates, hey, I'm going to find something else to do. You want to penalize me for keeping money in the bank? I'll take it out of the bank, but you're not going to get the financial activity that you want. And that's, to me, what this is all about.
I did a post yesterday on my blog, who benefited from negative real interest rates. I've gone back, interest rates for the last decade have pretty much been negative. The only time they weren't were right during the financial crash when the prices of houses, stocks, assets in general, literally everything crashed. The sad thing here is it's all extremely counterproductive. Rising productivity is inherently deflationary. We have more goods produced by fewer people with less effort and taking less money. The feds come along, central banks come along, and they say, well, we don't want that. The Bank of International Settlements, the BIZ, the Bank of Banks, if you would, or the Central Bankers Bank, as some people refer to it, did a study last year, and their perspective was that routine CPI deflations are not damaging at all, and they're not. The charts show that. The only time you can ever find it is going back to the Great Depression, and that was an asset bubble bust, not just routine price inflation bust. What central banks have done in their fight against cash, in their fight for inflation, is they've elevated the price of assets to the point where they've created bubbles. And the bubbles have been serial. Started off with a dot-com bubble in 2000, 2001. that morphed in when the central banks, when the Fed bailed out all of the banks that were in hock to the dot-com companies. They bailed out the banks via a housing bubble, and now they've bailed out the banks once again in the wake of the collapse of the housing bubble by creating a bubble in stocks and bonds. Meanwhile, the average guy is absolutely getting punished. This explains the rise of white anger. The Fed, I just posted today, the white anger sponsored by the Fed helped elect Trump. That's the irony of all of this. Everyone's railing against Trump. They're railing against Marine Le Pen in France. They're railing against Greek Wilders in the Netherlands. They're railing against Brexit. They still don't understand what's going on. And what's going on is the Fed and central banks brought about the very thing that they're railing against by repressionary financial tactics and in promotion of inflation.
Yeah, as you mentioned,
We can't.
go ahead, Ira.
No, go ahead.
I was just going to mention, as you mentioned, Mish, on your article yesterday, the median guy on the street is fed up by financial repression. That puts it up quite succinctly. Do you gentlemen see this happening or coming to North America, the Bank of Canada, Federal Reserve, or even in Europe, the ECB? Will they implement this type of policy?
Well, the ECB has already done it. The ECB has negative interest rates. We don't have it. The ECB was, banned the 500 euro note. So it appears to be coming. Well, the next big kicker we're going to see is on December 4th. On December 4th, two things happen. We've got a referendum in Italy, and Italian Prime Minister Matteo Renzi has vowed to step down if the referendum fails. And we have a election in Austria where Hofer, if I'm pronouncing his name correctly, is anti-immigration. He's running on that platform, and currently, not that the polls or the odds have been very good lately. In fact, they've been horrific lately, failures everywhere. But right now, the betting odds have Hofer an extreme favorite to win this. He will be the first anti-immigration nationalist president of any nation in Europe since the end of World War II. So this is what's coming, and they've brought it on, and their only answer is the very thing that caused the problem. You have Jean-Claude Juncker, president of the European Commission, saying, well, what this proves is we need more Europe. No, Marine Le Pen, Brexit, Hofer in Austria, and the rise of AfD in Germany are all precisely because they're angling United States of Europe. Juncker wants his own army, which is going to be, higher taxes. Let's be serious. Russia is not going to invade Austria or Poland. That's the fear. They propagate these ideas by the spread of fear, and they're all backfiring everywhere.
And
Ira, you wanted to make an observation? Yeah, go ahead.
Yeah, Mish is right. But let me throw this out at you, Mish, because I'm one of the greatest books written that has been very little read, of course, is The Rotten Heart of Europe by Bernard Connolly, which is still the best book written on the European Union and the Euro and all this affects. It's just an amazing book. But if Renzi, I argue in the blog for the last couple of days, if Renzi loses. He made a tactical mistake, but he'll walk that back because he said he'll resign if he loses. Not going to happen because Merkel and Hollande will not allow it. They will not allow, and Juncker certainly will not allow Renzi to resign. So what Renzi gets, he's actually better off losing because then he can blackmail Merkel et al. Into giving Italy more of what he thinks that they want, or at least as this you certainly discussed rightfully so, to prevent any more bail-ins of the banking system in Italy, which of course are coming, which will be politically disastrous. So if I was Renzi, I would be hoping like mad that I lose, because there's no way they can cut Italy loose. There's no way in the world. It can't happen. And they are, as Danielle wrote today, they are the third largest sovereign bond market in the world after Japan and the United States. Italy is. So you think about that, that should scare everybody. But if he loses, they will go into crisis mode, as of course we know everybody in Europe does. You know, all you do is look at Brexit. They were wrong about every aspect of it, and they're still wrong. And Tony Blair is an asshole of major proportions. Sorry, you can edit that out.
Okay.
Arrogant to the nth degree. But all these things are coming, and Renzi would be far better off if he loses. If he wins, they're going to say, "Oh, we beat back the populist uprising." Okay, you know, we're not a panic mode. Renzi will be a victor if Europe goes into crisis mode.
It's actually extremely difficult to say how this will play out. I personally believe if it's close, they might be able to talk him into staying, but I don't know if he will. And I disagree with you on this. I don't think it gives him all that much leverage over Merkel. But Merkel's problem is Merkel has her own problems. If she lets Italy bail out the Italian banks, then that's going to further fuel the rise of AfD in Germany, and further fuel the rise of perhaps people like Marine Le Pen. There are counter problems here. Actually, it's pretty much a losing situation, no matter how you look at it, especially if the one thing I agree with you is there's a real risk here that if Renzi wins by a tiny margin, that in the next elections, Beppe Grillo and his 5-star movement actually can win the next election, and he's running on a platform that's anti-EU and Eurosceptic. So we've got these multiple simultaneous battles going on in France, in Netherlands, in Austria, and in Italy. There is a serious risk of fracture. I think it actually happens in Italy, but a victory by Marine Le Pen is not out of the question. If you look at Fillon, who unexpectedly bumped out Nicolas Sarkozy, Marine, he is preaching more Europe, and he's also preaching the loss of tens of thousands of bureaucratic jobs. Marine Le Pen on that issue can actually run to the left of Fillon. She can pick up those votes. It is not inconceivable that for Marine Le Pen to win a one-on-one matchup here. The Greek Wilders right now, he might not be able to form a coalition, but it appears as an anti-immigration candidate is going to win the next election in the Netherlands. These attacks are going on everywhere.
There's
no win here for Renzi.
I agree with you, but let's come back to the point of okay, so what's going on here? In my opinion, and it's a very educated opinion, but that's why Draghi's in a hurry to keep piling on debt at the ECB. Because I always refer to that as in that great movie, The Bronx Tales, when they lock the guys in the bar, they say, now you can't leave. And Draghi's in a hurry because he's basically trying to create a synthetic euro bond by keep piling on the debt to the ECB. Because that begs the question, and I know what I say you're going to appreciate. Back in June, right after Brexit, I saw Jerome Powell, the governor, FOMC governor Jerome Powell, speak at the Chicago Global Initiative Group. And he was talking about Europe and Brexit. That was part of his conversation. And after listening to him, and I asked him a question pertaining to this, exactly what we're talking about. I said, who guarantees the ECB? Because if you have a sovereign bond, if you're going to create a euro bond, there has to be a guarantor behind it, right? So he gave me the answer, Mish, that I know you're going to just laugh at. He looked at me. He was uncomfortable with the question because I asked it in a very open venue. And he said, there's no worry. They have a printing press. I had no answer for it, but that was coming from an FOMC governor, and that was enough to set me on edge. I'm still on edge about that answer.
So what is happening today in the U.S. Bond market is a large sell-off on a Wednesday afternoon here. We're talking Eastern Central Time. And is all of this beginning to weigh on the global bond market?
I don't think yet, because, again, you have the ECB who starts fresh, a new 80 billion euro buying cycle tomorrow. Today's the last day of the month. You had the bond started to break today early, even though in Europe, the Italian and French yields were actually lower. They reversed by the end of the day as most things. But the oil prices, I think, unnerved the bonds, and you did have month end today. And you can only imagine the enormity of the losses on these risk parity models where everybody's been long. They've had huge amount of long positions in the bond ETFs and just outright bonds. So I think you saw some loss generating being taken today that helped drive the bonds a lot lower.
And I just wanted to also talk about your thoughts on infrastructure spending that's being announced in the U.S. and also in Canada. Do you gentlemen see that as being viable? Or there was a great article just came out by Professor Steve Hankey of Johns Hopkins University, and he doesn't think it'll do well due to cost overruns, a lot of waste in these type projects. Just wondering your thoughts.
There's always cost overruns. There's always waste. I question whether or not some of this stuff will even happen. I question whether or not Trump will be able to build a wall. It takes an authorization from Congress. I don't think he'll get that authorization. That said, I heard analysis in one other place. I forget where. Oh, it was by Rudy Giuliani, who said Trump really doesn't need that authorization. He can just simply divert funds from somewhere else. Well, okay, if Trump can actually divert funds, we're going to blow a lot of money on a wall. As far as wasteful spending goes, it's not the most wasteful thing in the world. Dropping bombs and making enemies is far more wasteful than building walls. But a wall won't do any good, and it will waste money. People want to come to the United States because of free benefits and free handouts. And if you want to stop people coming from here, you stop the free benefits and the free handouts. You don't build walls. But otherwise, yeah, I think we're going to see some of this. The stock market is mainly reacting, not to this infrastructure spending, but to the promise of all these tax cuts and on how inflationary this is all going to be. Well, when I look at a potential collapse in global trade because of what Trump is going to do, a potential collapse in the housing market if interest rates get much higher, a potential collapse in stocks if bond yields go up, I'm looking at what I consider to be actually very deflationary outcome out of this mess. So I disagree with all the people who just are taking this attitude that we are necessarily going to get immediate inflation out of all this. Down the line, I reserve to change my mind, but the immediate picture to me, and in light of productivity enhancements that is coming on with self-driving cars, where millions of truck driving jobs are going to vanish, millions of taxi jobs are going to vanish, perhaps another collapse in asset prices. This is a very, very, very deflationary setup. We're in here, and the rising dollar exacerbates that. Gentlemen, with that, I've got to go. I've got a few things I've got to get to. It was a pleasure being on the show.
Great, thank you very much, Mish. And I'll give you the last word. Ira, you mentioned on your commentary that debt will be the most important factor overhanging any Trump-inspired growth strategy.
Yes, I can't take my eyes off of that. And we've listened to guys who I certainly have phenomenal respect for, Stanley Druckenmiller and Gunlots have been talking about, 10-year yields going to 6%. They don't put a timeline on it, but with the huge amount of debt, I wrote the last week, because I can't just sit and listen to these people tell me this is a Reagan redo. It's nothing like a Reagan redo. It has not. The whole structure of markets and the economy are so vastly different. When Reagan came in, total debt in the United States, total debt, public and private, was $5.2 trillion, with a GDP of about $3.1 trillion. Today, the GDP is about $17.5 trillion. Total debt is $63 trillion. It's a far different picture. And if you have rates, don't forget, when Reagan came in, rates were being raised. He was trying to confront the problem that we knew, meaning Paul Volcker, which was to curb inflation. We don't know what the problem is right now. I mean, yes, to me it's debt, but if interest rates start rising willy-nilly, what are they rising in response to? And that makes this situation far different.
Yeah.
What we also have to confront is right now the Fed faces an absolute blowing up of its models. And why do I say that? Because if we in fact go down this road of a massive fiscal stimulus, infrastructure, whatever way it's going to be structured, at quote unquote full employment, well, they should be raising rates not by 25 basis points, but by 100 or 200 basis points, because that's what the damn model says to do. So how do they escape from this morass? We have this, listen, I understand the equity market's going up. I think Rick Santelli nailed it today in his solo piece that he did, where he talked about if Trump is able to get real tax reform, something similar to what should have gone on with Bowles Simpson, if he's able to roll back regulations, if they're able to fix the Affordable Care Act, okay, as well, especially with the regulations, and if they rip up Dodd-Frank and return to Glass-Steagall, which would be the easiest fix of all, it will be a phenomenal presidency. Phenomenal if you can do those things, because that would free up a lot. So that is sending the stock market higher. But I think it misses off. But in response to him too, the fact that Hillary Clinton was the anointed one, the market expected that. My thought was going to be if she won the election, the stock market I would look for the stock market to rally, because it would be more of the same in people's minds. But I was going to sell and liquidate my stock portfolio, except for some, high dividend yielders with enough cover. But for the most part, I was going to liquidate because there was long-term capital gains there. And I figured whatever the capital gains tax now was in 2016, in the Clinton administration, they were going to go higher automatically. And I think there were a lot of people who were thinking the same way as I was, but have now, with the Trump election, have backed off. So we're not going to get that huge amount of year-end selling of capital, capital gains, because a lot of people are thinking, well, I'm going to hold out for 2017 because I may see a lower capital gains rate. So that selling has not come to the fore. And I think that's, in a big way, some of the reason this market is going higher, because a lot of people were expecting that selling to take place and it has not shown itself.
Great. Thank you very much, Ira. That's great insight. Great insight from both Mish and Ira today. Look forward for another discussion next week. Great. Excellent. Thank you very much, gentlemen. And we'll have you back for another session of the Roundtable Insight. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.